George Soros is here. He is a billionaire investor, philanthropist, political activist, and author. His 10th and latest book, The New Paradigm for Financial Markets, The Credit Crisis of 2008, and What It Means, was recently published as an electronic book. In it, he writes that the global flight from the weakened dollar will have, quote, far-reaching political consequences and raise the specter of a breakdown in the prevailing world order. I am pleased to have him back at this table. A breakdown in the prevailing world order. Tell me how you see that.
Well, you went off at the deep end,
right?
In your introduction. But for the
I went to the pregnant point.
Since the end of the Second World War, basically, the dollar was the generally accepted reserve currency, right. And that status is now in doubt because the willingness to hold dollars has been reduced. And this crisis in particular brings that point home, because each time you have a recession threatening, you've got to lower interest rates,
right.
Put a lot more dollars in circulation, you have to increase, provide fiscal stimulus. Our budget deficit is going from $162 billion in 2007 to $450 billion in 2008, and it's going to be more like $500 billion in 2008.
And that's what percentage of GDP?
Well, I don't know. That's about, I don't know.
But because some people say as long as it's less than 5% of GDP, it's okay.
Well, yes, but nevertheless, it's a tripling in 1 year. And of course, as we are heading into a recession, 2009 is bound to be bigger. And that puts a lot of pressure on the dollar. It also puts pressure on the Fed, that it can't go overboard in lowering interest rates, because the decline in the dollar then translates into core inflation. Because now the renminbi, the Chinese currency, is appreciating at least 10%, but it's more like 15 to 20%. And that will bring maybe 1 or 2% increase in core inflation.
Right.
The goods in Walmart will cost more, not, of course, 15%
because of the inflation. But I thought we wanted the Chinese currency to appreciate.
Yes, we've been pushing for it because it's undervalued, but it does have that effect, and also the fact that people don't want to hold dollars, and there isn't really a very attractive currency alternative, because the euro is overvalued. Of course, it is still going up, even though it's very overvalued, because people want to diversify. But actually, what is happening is that the holders of dollars are now diversifying away from currencies to other kinds of holdings. So you have these sovereign wealth funds, which now amount to $2.5 trillion and growing at a very rapid rate.
Let's just stay with the dollar. What is the appropriate value, you think, of the euro?
In terms of cups of coffee, how much it costs here and there. But that's purchasing power parity. But you see all the people in New York who come over to shop here because it's cheaper. But that's not what determines the value of the currency. It's a matter of supply and demand.
But if, in fact, the currency is devalued and the dollar goes down, and therefore people are buying more American goods,
it helps to cushion the recession. It's a positive. It's actually an adjustment that was needed, because we have built up a ever-rising current account deficit. It was over 6% of the GDP. That's now declining, and that's actually a healthy adjustment, but it's also a very painful adjustment, because for the last X years, the average American did not have any increase in wages to speak of.
Absolutely.
But he could buy goods cheaper at Walmart and better quality, and he owned a house, and that house went up in value more than 10% a year. So he could go and refinance his mortgage and that was his savings. Now, that was a bubble. The bubble has burst. Housing prices are now falling, and these are very, very significant figures. The housing prices are now falling at an accelerating rate. Last month, they were falling at an annual rate of 25%, which is very rapid. We are now at the height of the season for selling houses, and nevertheless, prices are very soft. And you have an increasing number of foreclosures because there's been a lot of really loose, lax lending in the last few years. You have about 6 or 7 million subprime mortgages, and about 40% of them is going to default. And then you've got these adjustable rate option adjustable rate mortgages where you don't actually have to pay the interest, you can just add it to the principal. And a lot of those are now blowing up, and they will result in defaults. So you really have millions of defaults facing you. And as prices fall, more and more house owners will have negative equity. So the decline in housing prices is going to be much steeper than the authorities lead you to believe. Then it's also going to occur more sooner and faster than they expect.
Leading to what?
Well, leading to a recession.
We're already in a recession, aren't we?
Well, probably,
right.
Yes, but it's going to get worse. And the only point where I would say I differ from Bernanke is that he says that in the second half of the year things are going to rebound. I see absolutely no foundation.
No rebound at all, even a temporary rebound.
No, I don't see it. I just don't see because things are still accelerating on the downside.
So the decline in the housing market extends into 2009.
Right. Yes.
So, two questions. One, how bad can it get? And who suffers? And then what is the impact on Wall Street? What's the impact on the capital markets? What's the impact on average Americans in terms of wages and jobs and providing for their families? And what's the impact on America's relative position in the global economy?
And those are the two important questions. And of course, you cannot make any firm predictions because a lot depends on how the authorities respond to the challenge. And I argue that they will have to put taxpayers' money to work to arrest the decline in housing prices.
What does that mean?
It means that you've really got to find ways to minimize the number of people who lose their homes because of foreclosure, because that does two things. It exacerbates the pressure on housing prices, so it's self-reinforcing, and it has devastating social consequences, because this crisis is hitting certain particular areas and communities. It's disproportionately falling on African Americans. And very interestingly, it's really the upwardly mobile in Maryland, where I have a foundation. It's the district which has the richest African American community that is the most heavily hit, because they bought into this ownership, and the form of ownership they chose was housing, so they don't have other assets to sort of compensate for the decline in the value of houses. So it's really very, very severe social consequences.
So you're suggesting it will tear at the social fabric of the country?
Yes, yes. So action will be necessary, not only because of that, but because economically it's the right thing to do. Because you need to do something to arrest the housing decline, because otherwise it's going to overshoot on the downside in exactly the same way as it overshot on the upside. And the main thesis of the book is that both the authorities and the market participants have been relying on a false interpretation a false understanding of how financial markets work. They assumed that markets tend towards equilibrium, and that the deviations from that equilibrium are random. And that is false.
Deviations are what then? They're not random.
The deviations from the equilibrium are random.
Right.
So if you put together a bunch of mortgages and then you slice them up, you have a much better risk distribution than if you take individual mortgages. Therefore, they are safer when you package them together and securitize them. And this assumes that there can't be a systemic risk, that you can't have a bubble which drives up the prices first and then drives them down. That was left out of account when these packages were put together, and all the other synthetic instruments, many of the trading techniques that certain hedge funds use, they're all built on this assumption, and the regulators have also bought into this idea. I call it market fundamentalism, that basically markets are self-correcting, and therefore you don't leave it to the market to regulate themselves. And that's false. And this is what has landed us in the present difficulty.
You have said, and I think you said that this is the worst market crisis in 60 years.
Yes, our lifetime.
Our lifetime, since World War II.
Right. I don't remember the one in the 30s.
I don't either. So, who made the mistakes? I mean, you have criticized the laissez-faire government of both Margaret Thatcher and also Ronald Reagan.
Right. But I think that's when, you see, I think that we basically have two bubbles working at the same time. There's the housing bubble, which basically started in 2000. When
because of the new securities and the way they were sliced and diced.
Well, that's part of it, but basically what happened was we had another bubble, which was the IT bubble, and in order to get out of that bubble, the interest rates were lower, and then they were kept very low, 1%, until 2004, and that got the housing bubble going. So that's a relatively recent...
Meaning the interest rate was so low, people were buying houses they couldn't afford if interest rates changed, if they were adjustable and changed.
Right. It was a tremendous supply of money and led to this housing bubble. But then you have something which I call the super bubble. Ever since the end of the Second World War, credit has grown much faster than the GNP, and it has helped the growth of the GNP. And then starting in 1980, with Reagan coming to becoming president here, Margaret Thatcher in England, you had this misconception about markets, which are called market fundamentalism, that you leave the markets to their own devices. And the two together led to what the globalization of financial markets, the liberalization of financial markets, and this reinforced credit expansion. And interestingly, because markets don't tend towards equilibrium, but left to their own devices always get into trouble, and you have you had a number of crises, and each time the authorities came in and bailed you out.
So basically, if you look at what's being done today by the Federal Reserve, by lowering interest rates, by guaranteeing loans to bail out Bear Stearns, if you look at the stimulus package, and if you look at the regulations announced by Secretary Paulson, are any of those measures the right direction?
Yes, the fiscal stimulation, bailing out Bear Stearns, all those things are right.
Because of confidence, or because it changes the buying habits?
No, because it is the job of the Federal Reserve to not to allow the financial system to collapse.
That's what every central bank is supposed to do.
That's their job, and they did their job. But you see, that means that they had to intervene. Right? And so the error was not to recognize that if you are in the credit creation business, then you need that protection. And if you need that protection, then you need to be regulated so that you avoid the bubble from developing where the Fed has to come in. It's the job of the Fed to prevent asset bubbles from developing. But that task has not been accepted.
Not been accepted
by the authorities. They have not recognized that they have to do that. Greenspan spoke about irrational exuberance very early on.
But he was at that time was talking about the IT market.
Yeah, and it wasn't. People didn't like it. He stopped. He stopped. He didn't. And generally,
he was right.
He was right, but he didn't follow through. He didn't do anything.
Yeah.
You see now. It is really the job of the regulators.
And how long will this period last?
I think this is more serious.
Destruction and
it's more. This is bigger than the previous ones, because in the previous ones you could count on the Fed and the authorities to get you out of it, and this time they are more constrained. They're trying. They're doing the lowered interest rates and so on, and it's not enough.
So where are we then?
Well, we are on the verge, and we are now entering a recession.
But I mean, we're in a recession, and you're saying that the Fed is impotent to do anything because...
Well, they have done something.
Well, yes, but you're saying beyond that. I mean, there's not much more. So, and if it's getting worse, and their options to make a difference are restricted,
are limited,
then there's nothing. There's no good news around the corner.
There isn't, but they need to do more. And this is one of the things that I argue, that they have to directly address the issue of foreclosures, and while you have to protect the right to foreclosure, because without it, mortgages would have no value, and you would have no mortgages. So you have to have but you have to reduce the use of that mechanism by modifying the terms of the loans, reducing the...
or a moratorium on foreclosure? Or?
No, moratorium is no good. That's too drastic. You have to encourage renegotiating, modifying the terms of the mortgage, because everybody would be better off if you could do it without foreclosure. So that's one thing. The other thing is you've got to recognize that you've been working with the false paradigm, and this is very, very hard to accept. You can't. It's
the false paradigm that markets correct themselves.
Yeah, and it's almost unbelievable that this fabulous, powerful global financial system should be built on false premises. It's hard to believe, and yet it is true.
Let's assume you and I could put at this table the heads of the major financial services companies here, Citigroup and J.P. Morgan Chase and
they would not agree with what I'm saying.
Exactly.
They would not.
None of them would agree with what you said. For the most, you can find one maybe.
No, I think that maybe deep down, and in view of what's happening now, maybe they would agree more, and that's one of the reasons why I wrote the book, because this is the time to drive the point home.
Suppose I could at the same time put here the head of the central banks of the major industrial nations, the so-called Group of 8. Would they agree?
I think Volcker would agree, but of course he's no longer head of...
central bank.
I think I could name a few others who would agree, but...
Trichet would agree or not?
No. Trichet would not. I don't think Bernanke would. And generally, what I'm saying is a bit revolutionary. And that's why I said it 20 years ago.
Is there any irony here in the fact, I mean, some people are going to listen to this and say, wait a minute, this is a guy who cleaned up in the market. He became a billionaire, who bet at the right time on certain key currency exchanges and has done quite well, and has created enormous wealth, and yet he is basically saying that the market doesn't self-correct, and the market left to itself will drive us deeper into economic disaster.
Well, I think that...
So capital markets don't work. is what you're saying.
Well, they work, but they are imperfect. They are imperfect.
Well,
maybe.
No, but you're saying beyond the imperfect. You're just saying that capital markets, they don't work in a sense that
there are times when they break down.
And we're at a time right now where the capital markets have broken down.
That's right. I mean, everybody knows it.
Yeah.
I mean, I'm not saying anything. That's not news.
Okay, so
but think of this. Maybe the fact that I was able to make 40% a year on my capital had something to do with my knowing this, while other people.
Well, but if I looked at your investment, if I looked at your philosophy and then your execution, would I see that? In other words, are you suggesting your investment success is because you practice this principle that markets are not self-correcting?
Yes, in a way, but you see,
reflectively.
But you see, what my theory tells me is that there's a great deal of uncertainty, much greater uncertainty about markets, how they evolve, than we recognize. And therefore, I make many mistakes. And so, from time to time, I do it right. At other times, I do it wrong.
Well, people say that's the nature of markets.
Well, that's the nature. Yeah.
That's what they say.
Yeah.
Markets are about people doing it right and doing it wrong, and on balance, it sort of evens itself out.
But it doesn't even itself out.
Fair
That's the difference.
Okay, so in this global economic system we have today, where you've got nations like China and India growing in double-digit growth, are they immune from this?
No.
And is it the principal burden of what is happening to the capital markets going to be in the United States and Europe?
The second part is yes. This is basically falling on the United States and UK, to a lesser extent, continental Europe.
We'll go ahead.
And China will be affected, of course, because the dynamism of their economy is exports, and their exports will be...
So they may slip into single-digit growth rates.
And they may slow down, but they
into single-digit growth rates?
Yes. Well, actually, you see, they've got some other problems because actually they have the opposite problem to ours. They actually have an asset bubble right now because the currency is appreciating at 15%, let's say, and interest rates are 5-6%. So if you can invest in China in government bonds there, you get a 20% return. So actually, in addition to all the trade inflows into China, there's a lot of capital rushing to China.
So the wise money is going into China to buy their bonds?
Or invest in property or whatever. So if you got a lot of money, your advice to them is go to China. You've got a kind of asset bubble.
Well, then a bubble will burst. When is it going to burst?
Well, that's the question. So it's not so safe to go there, but as long as you are aware of it, it's not a bad thing.
Again, this is what makes markets.
Well, that's right.
Some have said the following. The Chinese were worried about an overheated economy, and it took an American recession to do it.
Right. That's correct. That's right.
So we have this global economic order.
Right.
Where does that put us? And what is the new reality for America as an economic power?
It is impairing that power.
Eroding it?
Eroding it. I wrote another book, The Bubble of American Supremacy, where I used this financial analysis of analogy of bubbles to President Bush's pursuit of American supremacy. And I said it's going to bust. And it has actually done tremendous damage to America's political and military power and influence in the world. So that's, we have suffered a big setback. Now we have a sort of a bit of the equivalent of that happening in the financial sphere. That is really what is happening. So the unquestioned dominance of the dollar is now questioned. And this creates a period of turmoil, just as politically you have turmoil because the world order, the political world order, comes back to your original question. The political world order was built on America as the dominant power, and then America failed in performing the role that was called upon, and that created a lot of uncertainty and turmoil in the world. And now the same thing is happening in the financial sphere, and there is no valid alternative to the dollar. The euro is not qualified to be the reserve currency. There's no, the renminbi certainly isn't, right? I mean,
the Chinese currency.
Yeah, there's no question of that. So therefore,
and the euro, you said, not either.
Euro.
So what are we left with?
So actually, you have this flight from currencies, which has created a commodities bubble.
Gold.
Gold, food,
right.
Copper, metals,
right.
And China is trying to invest in any kind of raw material in Africa. So you have an asset bubble, while you have this negative thing, the bursting of the housing bubble in the US. You have a global commodities bubble developing.
So everywhere we look, there's a bubble developing.
Well, there's a bubble,
a
bubble growing or
bursting.
Or bursting.
Yeah.
That is the way markets function, and it's high time that you should recognize that and stop talking about equilibrium.
Right.
It is the job of the people in charge of macroeconomic policy and the regulators to stop the bubbles from growing too big, so that when they deflate, they don't do too much.
And that's what they fail to do here.
And that is what they fail to do here.
And so we have a big mess.
And that's the problem. And I think it can be corrected if you recognize how financial markets work, and then you recognize that the authorities have this responsibility.
And then you have the political will to do it.
Well, then you develop the political will. And then you realize that it's not enough to control money supply, that this whole monetarist doctrine is a false doctrine that feeds right into this market fundamentalist ideology, that in fact you have to control the growth of credit, and it's not, you can't control credit purely through money. You have to take into account the prevailing bias, which may be optimistic or pessimistic. So you have to actually limit the amount of leverage that people can put on. You have to put on some limits on the borrowing capacity, and you have to impose stricter limits on banks if they lend to hedge funds that leverage 6 times their equity.
And what limits would you put on the banks?
Well, you would have to limit, as I say, they would have to
the debt equity ratio.
Yeah, they would have to have minimum reserve requirements.
Right.
This very interestingly, because there is this has to be done now that the markets are global. This has to be done internationally, and it has been done internationally. There is a Basel agreement on the reserve requirements of banks.
Right.
And there's Basel I, and there's Basel II, which is just coming in, which actually left it to the banks to determine the riskiness of their lending. There was the regulators abdicated the responsibility of deciding how risky their business is, because the business got very complicated. They couldn't understand it, but they said, well, the banks know what they're doing, so we just go by their risk. So that now, I think, is going to go out, and you'll need Basel III.
That's a
failed idea. And you'll need Basel III, which will put limits on leverage.
Where are you putting your money? Where's your money going?
I think I'm trying to balance things, so I'm not losing my capital. And basically, since most of my investments are long, most of my macro positions are short to balance them.
All right. Are you optimistic about anything?
Oh yes, I mean, I'm generally speaking optimistic because the fact that, let's say, this system proved to be imperfect, you know, it's natural because all human constructs are imperfect. That's the sort of the fundamental theory, and therefore, the big mistake you make is you think that just because socialism failed and government intervention in the economy failed, therefore markets are perfect. And you could make another mistake now, saying that because markets have failed, we have to regulate without,
right.
You know,
without wisdom.
Right. Now, you know, the regulators are also human. And what's worse, they are bureaucratic. And so you really only want to regulate as little as possible. But you need to understand that markets are imperfect.
Yeah, but see, I mean, this is just like everything else. It comes down to balance.
Right.
Trying to figure out the right balance.
That's exactly right.
Thank you for coming. Great to see you. George Soros, his book now, an electronic book, is called, guess what we've been talking about, The New Paradigm for Financial Markets, the Credit Crisis of 2008, and What It Means. And we'll be right back. Stay with us.